Welcome back to Market Meridian. If you're a macro trader, commodity investor, or anyone trying to navigate the chaos of 2026 global markets, this is the episode you've been waiting for. Right now, the world is staring down three seismic asset classes: crops, oil, and gold. Every trader is asking the same question: which one offers the highest probability, highest upside opportunity in the next 90 days? And which should you avoid, or at least rebalance away from? Today, we're delivering a definitive, data-driven answer. We're breaking down which crops to trade right now, with precise entry zones, price targets, and risk controls. We're also comparing them head-to-head with oil and gold, proving why, in this unique macro environment, crops are not just a good trade, they're the best trade. By the end of this deep dive, you'll have a complete playbook, which for crops to prioritize, how to structure your portfolio, and why this setup is more reliable than oil's geopolitical volatility or gold's interest rate headwinds. This isn't hype, it's a structural supply shock with inelastic demand, a once-in-a-cycle profit window. Let's start with the macro foundation. Why 2026 Q2 is the perfect storm for crop trading. The single most underappreciated macro event of 2026 is the Strait of Hormuz blockade, and its ripple effect on global agriculture. Since February 28, 2026, tanker traffic through the strait has collapsed by over 90%. This isn't a temporary disruption, it's a structural wound to global supply chains. Let's start with the hard numbers that make this non-negotiable for traders. The strait carries 46% of global urea exports, 45% of global sulfur, critical for phosphate fertilizers, and 25% of all seaborne crude oil. Gulf nations account for 30 to 35% of global urea exports and 20 to 30% of ammonia exports, and they've already shut down or cut fertilizer production due to the blockade. 190 million tons of fertilizer are stranded at sea, with no strategic reserves to replace them. Unlike oil, there's no SPR for nitrogen or phosphate. This is a fertilizer crisis, not just an energy crisis. Modern agriculture runs on precision nutrient delivery. Farmers can't make do with less fertilizer. The result? Reduced 2026-27 planting yields, tighter global crop supplies, and sustained upward price pressure. Here's the key distinction for traders: oil is driven by short-term geopolitical volatility, ceasefires, OPEC+ decisions, demand swings. Gold is driven by interest rates, dollar strength, and speculative flows. Crops are driven by irreversible supply constraints plus inelastic demand, a combination that creates a far more predictable, high-upside trade. Food is not discretionary. 800 million people face chronic hunger. Importers in Africa and South Asia have no choice but to buy staple crops, even as prices rise. This inelastic demand is the fuel that keeps crop prices rising, even when headlines calm. Now, let's move to the core question: which crops should you trade right now? We've narrowed it down to 4 high-conviction varieties, each with 25 to 60% upside, backed by supply-demand data and catalyst timelines. Not all crops are created equal. We've selected for that have direct exposure to the Hormuz fertilizer shock, strong liquidity, and clear near-term catalysts. These are the trade smart macro funds are piling into right now. First, rice, the highest upside, 40–60%, the number one crop trade. Why it's number one? Rice is the world's most consumed staple, and India, 25% of global rice exports, is facing a 30% urea shortage for its spring planting season. India sources 40% of its urea, 60 to 65% of its LNG, and 75 to 80% of its ammonia from the Middle East, all stuck behind the blockade. Global rice inventories are already at a 5-year low, and demand from Africa and South Asia is surging. The catalyst? India's mid-May planting report. If urea shortages worsen, India will likely impose export restrictions, exactly like they did with sugar in 2024. That will trigger an explosive price spike. Trading strategy for spot or Asian rice futures. Entry zone is $500 to $550 per ton, using the Thai 5% broken rice benchmark. Enter in the next 2 weeks, before mid-May data. Price target is $700 to $825 per ton by late June, which is 40 to 60% upside. Stop loss is 10% below entry, $450 to $495 per ton, to protect against surprise policy reversals. Catalysts to watch: India's urea inventory updates, mid-May planting progress, and export policy announcements. This is the highest conviction play in the entire commodity complex. No other crop combines such severe supply risk with inelastic demand. Second, soybeans, high upside, 30–50%, Brazil's fertilizer nightmare. Why it's a top trade. Brazil is the world's top soybean exporter, accounting for 60% of global supply, and it imports 80% of its fertilizers, nearly half via the Strait of Hormuz. The country faces a 30% phosphate supply gap, forcing farmers to cut soybean planting area by 5 to 8% for 2026-27. Adding fuel, rising oil prices are pushing Brazil to divert more sugarcane to ethanol, shrinking available farmland even further. The catalyst? Brazil's May planting report. If acreage comes in lower than expected, prices will gap higher immediately. Trading strategy for spot soybean futures, staggered entry, 50% at current levels, which is 1,156.50 cents per bushel as of April 14, and 50% on pullbacks to 1,120 cents per bushel. Price target is 1,500 to 1,735 cents per bushel by late June, 30 to 50% upside. Risk management. Hedge with short soybean oil positions. Soybean oil has already weakened, offsetting volatility. Catalysts to watch: Brazil's bi-weekly fertilizer import data, May planting report, and U.S. Corn Belt weather. Soybeans offer a perfect balance of high upside and manageable risk, ideal for core portfolio positions. Third, corn, medium-high upside, 25–40%, the triple threat staple. Why it's a must-trade: corn is food, feed, and biofuel, making it hypersensitive to fertilizer and energy cost spikes. Brazil's corn planting is hit by phosphate shortages, and U.S. farmers, the top global exporter, face soaring planting costs from energy and fertilizer. Current spot corn prices are 443.00 cents per bushel as of April 14, with modest gains but massive room to run. Chinese corn futures on the Dalian exchange are around 2,375 yuan, also with limited downside. The risk? Weather, but we mitigate this with options. Trading strategy for spot and Dalian corn futures. Entry zone is spot 440 to 445 cents per bushel, and Dalian 2,360 to 2,380 yuan. Price target is spot 550 to 610 cents per bushel, and Dalian 2,970 to 3,320 yuan by June, 25 to 40% upside. Risk management. Use call options, with strikes 10% above entry, to cap downside while retaining upside participation. Catalysts to watch: U.S. planting progress, Brazil's corn acreage data, and global biofuel demand reports. Corn is a core macro trade, less volatile than rice or soybeans, but still delivers strong returns. Fourth, urea, fertilizer hedge plus direct profit, 30–50%, the portfolio stabilizer. Why it's critical. Urea is the backbone of global agriculture. 46% of global exports pass through the Strait of Hormuz. Prices have already surged 54% between February and March 2026 and are up 80% year-over-year. With no strategic reserves, prices will keep climbing as long as the blockade holds. Urea moves with lower volatility than crops, making it the perfect hedge for your crop positions. It stabilizes your portfolio while delivering standalone profits. Trading strategy for CME Urea futures. Entry zone is $400 to $450 per ton. Price target is $520 to $675 per ton by June, 30 to 50% upside. Stop loss is 8% below entry, $368 to $414 per ton, tighter stop due to lower volatility. Catalysts to watch: weekly urea price updates, Gulf fertilizer production data, and Hormuz navigation status. Urea is non-negotiable for a balanced crop portfolio. It acts as both a profit center and a risk buffer. Now, let's settle the debate. Why are crops better than oil and gold right now? We'll break down the three asset classes head-to-head, using volatility, predictability, upside potential, and risk-reward as our metrics. First, crops versus oil, predictability over volatility. Oil's problem: oil is driven by short-term geopolitical noise, ceasefires, OPEC+ production decisions, and demand swings. For example, on April 8, a temporary US-Iran ceasefire caused WTI crude to plunge 20% in hours, erasing weeks of gains. OPEC+ can reverse production cuts at any time, flooding the market and crashing prices. Demand is elastic. If oil hits $120 per barrel, global growth slows, and demand falls, creating a ceiling on prices. Crops advantage: crops are driven by irreversible supply constraints, fertilizer shortages, reduced planting, that can't be fixed in 90 days. The supply shock is already baked in. Farmers can't undo reduced yields once planting season ends. Demand is inelastic. People need to eat, so prices keep rising even at elevated levels. Oil's upside is capped by demand destruction and policy reversals. Crops' upside is fueled by supply scarcity and non-negotiable demand. Next, crops versus gold, fundamentals over speculation. Gold's problem: gold is a sentiment-driven asset, tied to interest rates, dollar strength, and speculative flows. Right now, gold faces three headwinds. First, high real interest rates. The Fed has delayed rate cuts to 2026 Q3, keeping 10-year U.S. Treasury yields above 4%, raising the opportunity cost of holding non-yielding gold. Second, dollar strength. A strong dollar, with DXY above 105, weighs on gold prices, as gold is priced in dollars. Third, speculative profit-taking. Gold hit $5,000 per ounce in early 2026, and institutions are locking in profits, triggering sell-offs when volatility rises. Gold's upside is limited by monetary policy. Its downside is exposed to rate hikes and dollar strength. Crops advantage. Crops are fundamentally driven, supply and demand, not central bank policy or speculative flows. The fertilizer crisis is a real, physical supply shock that impacts every corner of global agriculture. There's no Fed pivot that can fix 190 million tons of stranded fertilizer or reduced planting yields. Crops offer tangible, supply-side upside. Gold offers speculative, sentiment-driven upside, a far less reliable trade for Q2 2026. Let's do a quick head-to-head recap. On upside potential, crops offer 25 to 60% with the four core trades, oil offers 10 to 20%, capped by demand, gold offers 5 to 15%, capped by rates. On predictability, crops are high, Due to irreversible supply, oil is low. Due to geopolitical noise, gold is medium. Due to sentiment. On volatility, crops are moderate and manageable. Oil is extreme with wild swings. Gold is high with speculative flows. On risk-reward, crops have an excellent 1:3+ ratio. Oil has a poor 1 minute and 1.5 seconds ratio. Gold has a fair 1:2 ratio. On catalyst timeline, crops have clear catalysts with May-June planting data. Oil has unclear catalysts with ceasefires and OPEC+ decisions. Gold has unclear catalysts with Fed policy. The verdict is clear. Crops offer the best risk-reward, highest predictability, and largest upside of the three asset classes in Q2 2026. Now, let's turn analysis into action with a risk-controlled portfolio blueprint you can implement this week. This allocation balances high upside with stability, maximizing returns while minimizing drawdowns. Position allocation, using 100% of your commodity capital, 40% high risk, high reward, rice at 20% plus soybeans at 20%, biggest upside tied to India and Brazil supply shocks. 30% medium risk, corn, balanced upside with weather exposure, hedged with options. 30% hedge stabilizer, urea, low volatility, direct fertilizer exposure, offsets crop volatility. This allocation ensures you capture the full upside of the crop boom while using urea to smooth out volatility, critical for surviving market swings. Here are the key catalysts to monitor weekly: real-time Hormuz navigation status, any easing triggers short-term dips, which are perfect entry points to add to positions. India's urea inventory and export policy, mid-May planting report is make or break for rice. Brazil's fertilizer import and planting data, bi-weekly updates drive soybean and corn prices. USDA June grain stocks report, confirms global supply gaps and validates price targets. Weekly urea and sulfur prices, early warning system for crop cost pressure. Now, non-negotiable risk management rules. First, stop-loss discipline, 10 to 15% below entry on all crop positions, 8% on urea, due to lower volatility. Second, options for hedging, use call options for corn to cap downside, avoid outright shorts on crops. Third, single position limit, never allocate more than 20% of total capital to any single crop, diversify across the four core trades. Fourth, catalyst-driven adjustments, if India announces export curbs, increase rice allocation to 25%, if Brazil's planting data misses, add to soybeans. Following this blueprint keeps you in control, even when headlines get chaotic. To sum up, the next 90 days are a defining period for crop trading, and crops are the undisputed best trade versus oil and gold. The Strait of Hormuz blockade has created a structural supply shock that no other asset class can match. Crops benefit from irreversible fertilizer shortages, inelastic food demand, and clear, trackable catalysts, a combination that delivers 25 to 60% upside with far more predictability than oil's volatility or gold's rate headwinds. Oil is a short-term geopolitical bet, gold is a sentiment-driven trade. Crops are a fundamental, long-cycle opportunity, the kind disciplined traders live for. Stick to the four core trades: rice, soybeans, corn, and urea. Monitor the catalysts religiously. Manage risk tightly. This crisis may threaten global food security, but for traders who understand the macro dynamics, it's a clear, high-probability profit window. If you found this breakdown valuable, hit the like button, subscribe, and turn on notifications. We'll be releasing weekly updates on crop catalysts and price levels. Drop your biggest takeaway in the comments. Are you already long rice? Which catalyst are you watching closest? I read every single comment. Until next time, trade smart, stay disciplined, and remember, In Q2 2026, the biggest profits aren't in oil or gold, they're in the crops that feed the world.